Hey all, Chris Ulrich, United Home Loans, mortgage tips and everything else, and today I'm talking credit reports, what we're looking for, and why it's important we pull credit early in our discussions at the very beginning stages of the home buying process. First off, yes, I have to pull credit. Oftentimes clients are hesitant to have me pull credit right off the bat. However, it is necessary in order for me to fully assess your credit profile to give you good, legitimate, honest feedback. Credit reports don't just give me your credit score, but it's going to give us the history of timely payments, whether or not you have collections or debts that can be paid down, whether or not your student loans are in deferment, if you've had a previous foreclosure, bankruptcy, or short sale, and everything from the limit and balance on credit cards to whether or not your car payment is a loan or a lease. So if you want to know how much home you can afford, then I absolutely am going to have to pull credit. Now, credit scoring can be a bit of a mystery as the bureaus don't necessarily spell out what you should be doing in black and white. However, there are some simple steps that we can follow to make sure your credit profile is as strong as possible when you're going to buy a home. First off, pay your bills on time. Seems like common sense, right? But not everybody follows the rules. Being 30 days late will trigger the creditors to report you as delinquent to the bureaus, and having just one recent late payment can dramatically lower your credit scores. So pay your bills on time. 2. Keep your credit card balances below 40% of the limit on those cards. Now some people will say keep it below 50%, others will say keep it below 30% of the limit. Regardless, if you keep your balances in that range or below, you're going to be in a far better position than somebody who's maxing out their credit cards. And it doesn't matter what the limit is on the card, it's all about the percentage or the utilization of that card. For example, if somebody has a credit card with a $1,000 limit and a $750 balance, that's a 75% utilization. Now take somebody else with a $10,000 limit credit card and a $4,000 balance. Even though that person technically has more debt, they're just a 40% utilization and their credit scores are going to be impacted far less than the other. 3. Pay off active collections. Now I have to be careful talking about this one, and I say active because typically if it's a new or relatively new collection, not only are they reporting to the bureaus as a collection, but they may also be reporting you as late month after month, and the only way to stop the bleeding is by paying that collection in full. Other times you may have an old collection or one that's sitting dormant and just isn't reporting to the bureaus the same way. Well, if you start paying on that old collection, it might bring it back to life and affect your credit scores negatively. So you have to do your research on that, but I think a good rule of thumb is pay your debts. 4. Limit your credit inquiries or how many times your credit report is pulled. One reason people are hesitant to have the report pulled right off the bat is because even though it is necessary, it can ding your scores a few points. Well, one nice thing in which many people don't realize is that if you're shopping around, doing your diligence, talking to multiple mortgage companies and having multiple mortgage credit reports pulled, as long as it's within a 45-day window, it's only going to impact your scores as if it was one single pull. And this is protected by the C.F.P.B, or the Consumer Financial Protection Bureau, and I've provided a link in the description with more information. This is all because they realize you're being financially responsible and trying to shop around. And this is different than somebody who has their credit report pulled by multiple credit card companies, where it looks like they're just trying to accrue a whole bunch of new revolving debt. And finally, get your free annual credit report so you can monitor your scores over time. I provided a link in the description below to help with that. Now, it's important to monitor your scores for obvious reasons, but it's more important to understand what to be looking for. And more so than the score itself is the trend or the trajectory of your scores over time. And the reason the trend is more important is because there are multiple scoring models within each bureau depending on whether you're getting a home loan or you're applying for an auto loan or a credit card or just getting your free online consumer report. So no matter what score you tell me, it's going to be completely different when I pull. So follow my tips, monitor your scores, and you'll be setting yourself up for success when you go to purchase your next home. As always, if you have questions, please don't hesitate to reach out directly. I'm happy to help. Cheers.